What if I told you there was a portfolio designed by one of the most successful investors alive that actually made money during the dot-com crash, almost broke even during the 2008 financial crisis, and has delivered consistent returns for over 25 years? Not a hedge fund you need millions to access. Not a complicated option strategy. A simple 5 ETF portfolio that anyone watching this right now can build in under 30 minutes with as little as $500. That portfolio is Ray Dalio's all-weather portfolio. And in this video, I am going to build it from scratch, live for 2026. Exact allocations, exact ETFs, exact steps, nothing held back. By the end of this video, you will know exactly what to buy, exactly how much of each, where to buy it, and why this particular combination of assets is designed to perform in every single economic environment. Growth, recession, inflation, deflation, all of it. Stay for the 2026 update at the end, because I have made one important modification to Dalio's original model given the current war economy and inflation environment. That change could matter significantly to your returns. Before we build a portfolio, you need to understand who created it and why it works. Ray Dalio founded Bridgewater Associates in 1975 from his 2-bedroom apartment in New York City. Today, Bridgewater is the largest hedge fund in the world, managing over $150 billion. His clients are not retail investors. They are sovereign wealth funds, pension funds, and central banks. The most powerful financial institutions on earth trust Dalio with their money. Dalio spent decades studying economic history, going back hundreds of years across dozens of countries. His obsession was a simple question: is there a portfolio that would have protected wealth across every economic environment throughout all of recorded financial history? The all-weather portfolio is his answer to that question. He built it not for performance in the best of times. He built it for survival in the worst of times and consistent growth in everything in between. He has said publicly, you cannot predict the future. You can only build a portfolio that does not need to. To understand why the all-weather works, you need to understand Dalio's framework. He argues that there are only 4 possible economic environments. All economic conditions at any point in time fall into one of these 4 boxes. Environment 1, rising growth and rising inflation. The economy is expanding and prices are going up. Think the mid-2000s or 2021. In this environment, the winners are stocks because company earnings rise, and commodities because raw material prices rise with inflation. This is why the all-weather holds both. Environment 2, rising growth and falling inflation. The economy is growing, but prices are stable or falling. This is the ideal environment. Stocks perform powerfully, earnings grow with no inflation headwind crushing purchasing power. Bonds also benefit as rates stay stable or fall. The all-weather's 30% stock allocation earns here. Environment 3, falling growth and rising inflation. This is called stagflation, and it is the most dangerous environment for most investors. Your stocks are falling because the economy is weakening. But inflation is rising, which means bonds are also getting crushed. The only assets that protect you here are gold and commodities. This is exactly why the all-weather holds. Environment 4, falling growth and falling inflation. Recession or deflation. Most assets fall, but long-term government bonds thrive, investors rush to safety, bond prices rise, yields fall. This is why the all-weather has its largest allocation in bonds, 40%, because bonds are your deepest protection in the worst economic scenario. And here is the core insight that makes the entire strategy work. Nobody, not Dalio, not the Federal Reserve, not any economist on earth, knows which of these four environments is coming next. The environment can shift in weeks. It can change without warning. So Dalio built a portfolio that holds something that wins in all four simultaneously. Not trying to predict, just covering every scenario at all times. Now let us look at exactly what is in the portfolio and why. Stocks 30%, ETF 50 VU or FZROX. This captures economic growth. When the economy expands, stocks rise. 30% is deliberately modest because stocks are the most volatile asset in the portfolio and the all-weather trades some upside for stability. If you are at Fidelity, use FZROX, it has literally zero expense ratio. Zero. At any other brokerage, use VTI or VU. Long-term bonds, 40%. ETF, TLT, the iShares 20-plus year Treasury ETF. This is the largest allocation and it is deliberate. Long-term government bonds are the most powerful safe haven asset in a recession or deflationary environment. When everything else is falling, these rise. 40% gives the portfolio its bedrock stability. Intermediate bonds, 15%. ETF, EF, the iShares 7 to 10 year Treasury ETF. This acts as a second layer of bond protection with slightly less duration risk than TL. It balances the bond side of the portfolio and smooths out volatility from the long-term bonds. Gold, 7.5%. ETF, GLDM, EAL, or GELD. Gold is the crisis hedge. It wins in stagflation and during geopolitical chaos. It has held value for 3,000 years across every currency collapse in history. 7.5% is enough to provide meaningful protection without dragging on returns during growth phases. Commodity, 7.5%. ETF, DJP, or PDBC. Commodities, oil, wheat, metals, agricultural products, rise during inflationary periods. They are the counterweight to bonds during environment 3, stagflation. Without them, the portfolio has a meaningful gap. Total, 30% growth assets in stocks, 55% in bonds for protection, 15% in gold and commodities as an inflation and crisis hedge. Always balanced, always covered. Now let us look at what this portfolio actually did when things got bad, because a strategy is only as good as its worst day. The dot-com crash of 2000 to 2002. The S&P 500 fell 47%. Nearly half of all value in American stocks was destroyed. The all-weather portfolio, it returned positive 5%. While equity investors were wiped out, all-weather investors made money. The 2008 financial crisis, the worst market event since the Great Depression. The S&P 500 dropped 38% in a single year. Millions of retirement accounts were devastated. The all-weather fell just 3.9%. 3.9. That is arguably the single greatest validation of a portfolio strategy ever recorded. 2020, the COVID crash. In March alone, the S&P 500 fell 34%, one of the fastest crashes in stock market history. The all-weather fell 12%. Still painful, but compared to 34, it was a completely different experience. And when markets recovered, it recovered with them. Now, I am going to be completely honest with you. The all-weather is not perfect. In 2015, during the China market crisis, it actually underperformed the S&P slightly. And 2022 was its worst relative year. Both bonds and stocks fell simultaneously when inflation spiked unexpectedly. The S&P fell 18%. The all-weather fell 21%. Why did that happen? Because both of the portfolio's largest asset classes, stocks and long-term bonds, fell at the same time. That is the one scenario the original all-weather did not fully anticipate: rapid, unexpected inflation after a decade of near zero rates. And that is exactly why I have a 2026 update for you in a moment. The 25-year average tells the real story. S&P 500, 9.8% per year. All weather, approximately 8.5% per year. Half a percentage point difference in average returns, but with dramatically lower volatility, far smaller drawdowns, and the ability to sleep at night during every crisis. That is the trade-off. And for most people, it is absolutely worth it. Here is the 2026 context you need to understand. We are in a war economy. Geopolitical instability is at multi-decade highs. Inflation, while cooling from its 2022 peak, remains structurally elevated above central bank targets. Recession risk is real. And the Federal Reserve is navigating one of the most complex policy environments in its history. This environment, multiple simultaneous threats, elevated uncertainty, inflation risk, and geopolitical danger, is precisely what the all-weather was designed for. But given 2022's lesson about bonds and inflation, I am recommending one specific modification. Reduce long-term bonds from 40% to 30%, and increase gold from 7.5% to 12.5%.
Here is the complete 2026 build. Stocks, 30% FZROX at Fidelity, 0.0% fee, or VTF 0.03%. No change here. Total U.S. market exposure remains the core growth engine. Long-term bonds, 30% TLT ETF 0.15%, reduced from 40%. Long-term bonds remain critical for recession protection, but their vulnerability to unexpected inflation means a slightly lower allocation is prudent in 2026.
International bonds 5% NBNDX ATF 0.07%, new addition for 2026. The Vanguard Total International Bond ETF adds geographic diversification to the bond allocation, reducing dependence on U.S. monetary policy alone. Intermediate bonds 15% NDF TF 0.15%, unchanged. The 7 to 10-year Treasury position remains as the balanced bond cushion. Gold, 12.5% NGM ATF 0.10%, increased from 7.5%.
In a war economy with persistent inflation risk, gold's role as a crisis hedge and inflation protector is more important than ever. GLDM is the cheapest gold ETF available, 0.1% annual fee. Commodities 7.5% PDBC ETF 0.59%. Unchanged. Broad commodity exposure remains essential for inflation protection. Total weighted expense ratio approximately 0.10% per year. That is essentially free to maintain. Now let me show you exactly how to build this. 5 steps. Anyone can do this today. Step 1, open a Fidelity account at fidelity.com. It takes 10 minutes and it is completely free. I also recommend opening a Roth IRA here at the same time. Building the all-weather inside a Roth IRA means all your gains are completely tax-free. That is a powerful combination. Step 2, fund your account. Fidelity allows fractional share purchases for as little as $1. You can start with 500, 1,000, or 5,000. The percentages work at any size. Step 3, buy each ETF in the correct percentage. Let me give you a real example. On $10,000, put $3,000 into FZROX, $3,000 into TLT, $1,500 into ETH, $1,250 into GLDM, and $750 into PDBC. That is your complete all-weather portfolio for 2026. Step 4, set a calendar reminder to rebalance once per year. That is all the maintenance this portfolio requires. Once a year, look at what has drifted above its target percentage, sell a little. Look at what has fallen below, buy a little. This takes 20 minutes. That is the total annual time commitment. Step 5, auto-invest new money every month in the same proportions. Dollar cost average into all 5 positions simultaneously. This removes all timing decisions from the equation entirely. You do not need to think about whether the market is high or low. You just keep buying. And here is the most important rule. Do not change your allocations based on news, market moves, or how you are feeling. The strategy is designed to remove emotion from investing. The moment you start adjusting based on headlines, you have defeated the entire purpose. Let me give you an honest comparison, because I know some of you are thinking, why not just buy the S&P 500 and get 9.8% per year? Here is the truth. The S&P 500 is a better investment for someone who is young, say 20s or early 30s, has a 20 to 40 year time horizon, has high emotional tolerance for watching their portfolio drop 30 or 50% without selling, and does not need to access this money for decades. The all-weather is the better strategy for someone who is 10 to 30 years from retirement, wants to protect wealth they have already built, cannot stomach watching half their portfolio disappear in a crash, or is in a volatile income situation, like many of you watching this as an expat or self-employed individual. The numbers all-weather gives you approximately 8.5% per year with a maximum historical drawdown of around 15%. The S&P 500 gives you 9.8% per year with a maximum drawdown of over 50%. You are trading 1.3% in average annual return for dramatic reduction in risk and volatility. My recommendation for most people watching this, a hybrid approach. Put 70% into the all-weather structure and 30% into pure S&P 500 index funds. You get the stability and all-season protection of Dalio's model, combined with slightly higher long-term growth from concentrated equity exposure. The best of both. The all-weather portfolio is not exciting. It is not going to make you rich overnight. It will not double in a bull market, but it will still be standing and growing when the next crash comes, and the one after that. That is the point. Slow, consistent, all-weather wealth building. Exactly what the name says. If this video helped you, please hit like and subscribe. We publish every Monday, Wednesday, and Friday. Drop a comment below. Are you going to build the classic all-weather, the 2026 modified version, or the hybrid approach? I read every single one. And if you were an expat investing from outside the US, our next video is built specifically for you. I will see you there.